Hey everyone, welcome back to Corporate Decoder, the place where we help you understand the crazy language of Wall Street. Ever wondered what a company really means when they say they're ready to blaze a trail? Well, this blank check company will try to do just that, and we are here to decode their goals, financials and risks involved. And join us, Trailblazer Acquisition Corp, or BLZR, just filed its S1 form with the SEC, a document necessary to register their intent to go public. Essentially, they are trying to raise $200 million through this offering. These guys are a blank check company, also known as a SPAC, meaning they don't have any specific business operations yet. Their whole goal is to find one or more companies to merge with, bringing that private company to the public markets. As typical, they won't limit themselves to any specific industry, but will focus on industries that align with the backgrounds of the management, meaning media, technology, as well as retail businesses. But it's a big world. In essence, the investors are betting on the management's ability to find a good target, but who are these people anyway? Eric Simler, a guy with a background in both investing and media, is the CEO and chairman. He even had his own investment fund that was one of the biggest in tech and media. Tad Smith is also coming on as an independent director after being the CEO of Sotheby's, so these guys are definitely very experienced. The chief financial officer is Eamon Smith, who was also CFO at Semler's investment fund, so the team is very tight-knit. Their acquisition strategy and criteria focuses on large markets with favorable dynamics that are also market leaders with proven unit economics. This might seem ambitious, but this is what the management is looking for when searching for a target to acquire. The filing goes on about the compensation and amounts related to the sponsor of the deal, Trailblazer Sponsor LLC, the officers and directors. This is important to be aware of because they have specific costs and levels of compensation that influences the outcome of this business combination. Some members of the team are getting founder shares for next to nothing. In all, the founder shares are about a $4 million payment that this team is getting paid. Our main numbers about who is getting paid what? The entity itself is getting 5,750,000 Class B ordinary shares for just $25,000. But up to 750,000 of these can be surrendered if the offering is not oversubscribed. They're also picking up 2,000 of these can be 66, 66, and 667 private placement warrants for $4 million. That comes up to $1.5 for warrant. They can also get up to $300K for the reimbursement of various loans, in addition to $10K a month for basic expense. On top of all of that, though, the independent directors each get 25,000 founder shares just for sitting on the board. Same for the CFO, which comes out to about 90K founder shares in total. And the Class A ordinary shares issuable in connection with the conversion of the founder shares can result in material dilution. Essentially, the insiders want to be paid a lot in founder stock. Let's talk about some financials. As of June 30 of 2025, Trailblazer had assets of about 43.6K, but working capital deficient of about the same amount, $37.5K to be exact. The net tangible book value is sitting roughly around 6K, nothing too crazy. Let's check what happens to these numbers assuming adjustments from IPO. So here we can see some of the adjustments that'll happen after this deal closes. Most striking, the total liabilities will jump to about $8 million. Thanks to $8 million also that is being taken from proceeds to pay deferred underwriting commissions on top of $200 million towards their Class A ordinary shares ICE as well. As with any investment, there are a few risks. Here are a couple standouts. There's a major risk that investors won't get a chance to vote on the business combination. Also, the sponsor is incentivized to take a deal that might be riskier if it means they get payout. And of course, something happens to the economic stability, the price of your investments might fluctuate. So all things to consider when investing. It has come to our attention that Trailblazer might need additional financing, diluting any investor's equity or convertible debt in what might possibly be the future. Not great. A major detail is that for now, only the insiders, the Class B shareholders, are the ones who can remove and appoint the directors until the first business combination transaction takes place. So it seems like the commoners have no say. Given there aren't a lot of rules when it comes to these types of SPACs, real or perceived, there is still the potential for conflicts of interest. All of this means you have to remember that you are basically betting on management and be aware of their incentives. Digging into their projected book value with a 10 times to 0 offering price, post-IPO book value could range from as high as 7.70 to as low as approximately negative 129 cents per share. All of this depends on the percent of redemptions though. As those percentages hit close to 100, the value of what you as a shareholder would hold is reduced. There is no guarantee of this thing being profitable or even worth the money that is going in. Alright, that's our breakdown of the Trailblazer acquisition Corp filing. This might seem like a gamble, but it is all about what business the management chooses to play with. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.